Hello and welcome to another episode of Kuvera Insights, where we talk to leading industry experts and learn on how to manage our wealth better. Today we have Raghav from Axis Mutual Fund. He has 25 years of experience in financial industry, driving sales and distribution. He's joined Axis in 2019 as a president and chief business officer, responsible for retail and institutional sales, investment services, and digital and marketing. Prior to joining Axis, Raghav ran the India Bulls AMC as their CEO. And prior to that, he's worked with ICICI, Tata, JF, AMC, and DSP. So, of course, very rich experience in the mutual fund industry. Has probably seen the industry evolve in the last 25 years to become what it is today. So, look forward to this really interesting conversation. Thanks for joining us today, Raghav.
Thank you very much, Gaurav, for having me on the show. I think 25 years feels like a very long time, but I must start this conversation by just telling you an interesting anecdote.
Sure,
I
please.
don't know if you're aware, there is this new industry initiative which is started off called MF Central. So essentially, customer can go in and look at his or her data. I mean, on mutual funds.
Right.
I had put some 1,000 rupees in a mutual fund very, very long time back. Which is not 1,000, about 10,000 as a SIP, and then those days you had to give post-dated checks, right? There were no UPIs and stuff like that. So I gave the first year checks and then I promptly forgot about it because obviously I started traveling and my bosses kicked me around all over the country. And the one thing that you tend to forget to do is give the new set of checks. Now, while I was going through that, so that 12,000 invested value, Gaurav, it's not in a great performing fund. It's not like one of those really top of the line funds. But today I was quite zapped. I think that value is almost about, it's almost about 2.3 lakh rupees.
Fantastic.
Yeah, and it's just because I forgot about it, in the sense that because I was so busy doing my stuff, and frankly,
you let it compound. That's what happened, right? You gave it time, whether you consciously did it or not. That's the anecdote.
I completely unconsciously did it because I didn't even know it existed. I mean, it was 1,000 rupees put every month. In fact, it was not some large amount of money which you tend to sort of keep monitoring. It was just sort of went out of the pocket. And so in some sense, Gaurav, that is the sum and substance of my experience. I mean that if you give an investment a decent amount of time, and in the situation where we are in today, where, of course, we have COVID, we have climate change, we have all kinds of crazy things happening, but typically equities and good companies will give you decent returns. And if you are able to capture that over a period of time without getting worried about what the federal governor is saying or what the finance minister is saying or what that stuff, I think you'll be far better off. And hence that I was very, very happy when you asked us to do this, because I think you people reach out to so many investors. It's actually quite amazing.
I mean, that's I think what Raghav just said, that's the first rule, right? Invest right and sit tight. Sit tight is the hard part. But he did it for a very long period of time, and the fund value has grown close to 20x. That's really good to know for people also who kind of, it's always good to have these examples where people have done, 10x, 20x over long periods of time. So let's start with, you kind of briefly mentioned COVID and climate change and so on and so forth. And now there's, again, questions on Fed tapering and taper tantrum and so on and so forth. What's the current market outlook like? And what would be your, top 2 or 3 pieces of advice for a retail investor, what that you have learned in your 25-year journey?
So I think in terms of current markets, if you go back to the early 80s, Gaurav, the Sensex used to be like 129. And I'm talking Sensex, not Nifty.
Right.
Today it's whatever, 57, 58,000. And every time it hits a certain milestone, if I may use the term, 10,000, 20,000. These are all milestones in people's mind, right? And
a large round number is a milestone. I understand exactly what you're saying. A large round number is a milestone.
60,000. Nothing. I mean, so my 2 bits to people are that, hey,
जो 59,999 पे गया था वही 60,000 पे
60,000 में करना पड़ेगा. So so I said you have to invest. Equity has to be a fundamental part of your investment, right? There are 2 ways to do this. There's obviously one way that you go and do a fair amount of research yourself. You understand companies. You go and there's a lot of information available today, and there's a lot of knowledge in the open, which was not there when I started my career 25 years back. Like if you wanted to be a good fund manager or you wanted to be a good money manager, you had to sit in Bombay because Bombay had locational advantages. All the corporates were here, the banks were here, the research analysts were here. Frankly, that doesn't exist today. You could be sitting in any place in the world today, frankly, not even in any of our top metros, and you could be doing a much better job of managing your money. Having said that,
You might actually have less noise there,
best lordship, yes. Having said that, there are people like me who say, "Yeah, I'm not great at managing my own money. I'd rather give it to somebody and let him or her manage it for me." And obviously, there I like to see a certain process. Fortunately, again, the regulator has been super proactive as far as the mutual fund industry is concerned. So today, everything right from portfolios to daily NAVs to redemptions, everything is crystallized, standardized, and more importantly, followed to the T. So you've got a
Right.
great first industry, which is cost effective now, because as and when the fund sizes go up, automatically the costs come down, which was not the case earlier. Not great for asset management companies, obviously, because our P&L goes off a little bit, but it is an aspiration for us to obviously keep growing. And obviously, my belief is that if the investor, who's the ultimate customer, makes money and he has a good experience, automatically all of us will go and vice versa, right? So from a market perspective, you've got a lot of clouds in the horizon. We've seen that there is one of the reasons this market moved so rapidly up is two things. Actually, the big reason is, of course, that India came out of COVID very fast, right? Compared to many parts of the world, which are yet going through third wave and fourth wave and stuff like that. And I think that is for two reasons. One is, I think as a nation, we are very jugadu. We are used to a frugal mindset. So whenever things get tough, actually, we get much better. In fact, I think as a country, we tend to do badly when we have got excess of something. That's my personal view. So we managed to get this whole our entire ecosystem changed. We adapted to work from home. We got our shorts done. We are very disciplined. Even today, if you go out into markets, at least in Bombay where I stay, people are wearing masks. Hotels are insisting on masks. So that's a very big difference from what's happening internationally, where there's yet this whole freedom of choice and it's my life and my life and stuff like that. And people don't really are not really worried about. Personal expression is much more important than collective responsibility there. So I think the thing is that, yeah, you got this Omnicom virus, which looks like a villain out of the Transformers journey. I don't know if Gaurav, maybe you've seen the old Transformers series, but if you go back and
I have. I mean, yeah,
so,
I'm a
so
comic book fan
when
as
I
well.
saw this name, I said this is straight out of Transformers 4. This guy looks like a straight villain. Now the jury is out. We don't know
Yep.
whether it's spreading, not spreading. And I don't want to go down that road. I can only say that we've got a lot of vaccinations done. We seem to be taking the right steps, and there will be and governments will, as usual, overreact a bit because they want safety. So at best, you could see a bit of a blip in terms of movement in case, and that obviously will lead to a blip in terms of profits, right? At worst, I don't see things going crazy that we go back to the March 2020 kind of a shutdown. So you may have pockets of stuff happening. People will insist on a more couple of things. Like now today, if you want to come back into Bombay from anywhere outside Maharashtra, you have to have an RT-PCR again. So all that stuff is going to happen. But is it going to fundamentally make our GDP go down by minus 10%? No. The second thing, of course, is that global liquidity, which is largely a creation of various central banks, and the largest being the Federal Reserve in the US, is now talking of actually because now they are really worried about inflation in the US. So obviously, they also want to come back and curtail liquidity. Now, India is a growth market. I mean, everybody knows that. So there are some people who obviously borrow and invest, like many of us do sometimes, and they're smart people. So the people who are borrowing to invest may be taking out some money because they could have a situation where rates are going to go up. And they feel that the money that they will make after borrowing will be possibly less. It's not worth the effort. But if you ask me, people like, let's say me and maybe many of your viewers are just, buy and hold investors. We are those 20-year investors. For us, we should use those guys exiting as an opportunity for us to get. I'll only put all this advice into a small circle and say, if there is something called a total equity allocation you should have. I mean, there are various theories to it, 100 minus your age, etc., etc. Largely, these are things that are best done in consultation with some expert because every individual is different. But if your equity allocation is less, or you think it can go up a little more, time to use this volatility in the market, make volatility your friend, and sort of land up putting some more. If your equity allocation is anyway great, and you feel that you're comfortable and you're getting good sleep in the night, you don't give a damn whether markets are down 1,000 points or up 500 points. You have a certain goal in your mind and you want to achieve that. I think just hold on, yeah, and I think let your investee companies do their job and make money for you. That's important.
So let's talk about equity, right? And I think you guys have a very good process-driven large cap, mid cap, and small cap fund, and now there's multi-cap and flexi-cap.
Yes,
How does an investor, actually large cap, mid cap, small cap is very well defined. I
absolutely.
mean, the SEBI has this categorization that works really well in defining what's a large cap, what's a mid cap. There's no ambiguity there, right? So, but how does an investor think about multi cap and flexi cap? What is a multi cap fund? What is a flexi cap fund? What are some of the differences? What are some of the advantages of either? And then we can kind of do a bit more of a deep dive on how to think about these specific fund categories.
So I think fundamentally, as you rightly said, Gaurav, there is large cap, mid cap, small cap. Uh, these definitions are companies which have large cap are companies which have a market cap of more than 10,000, 30,000 crores. Mid cap are companies which have a market cap of 10 to 30,000 crores, and small cap are companies around 10,000 and below. So as you can make out, this is broadly covers the entire spectrum of companies available for investment in India. This is a regulation. This is not Access Mutual Fund definition. This is the industry definition.
Right.
Now, coming to FlexiCap and MultiCap, ultimately the job of the mandate underlying is the same in the sense that in the FlexiCap fund, you've given the mandate to the fund manager to do whatever he wants, he or she wants. They can put money into either large, mid, small, in whatever percentages they need. In multi-cap, it's a little different. There's a new category which which SEBI came up with recently, saying that you have to have a minimum of 25 in large, minimum of 25 in mid, and minimum of 25 in small. No overseas exposure. It has to be all Indian domestic equities, and the balance 25%, and I've covered 75, is something that you can do at your discretion. You can choose to put it in large, mid, or small. That's your call. And so broadly, so if you look at the similarity, Flexi and Multi both can invest across the market cap spectrum, but Flexi does not have this 25, 25, 25 limit. He can go and put 100% into large cap, for example. Now, typically when you to create wealth, everybody knows that it's the easiest. I mean, it's the easiest thing to talk, but most difficult thing to do is to try and catch a company when it's small and then ride it. We invest in it right through its lifetime journey, and hopefully a small cap company will become a mid cap company and then a large cap company. So typically in the multi cap fund, the biggest advantage, Gaurav, is that you can see a company right through its life cycle. Because I will buy it in a small cap, let's say it does really well, I'll go into mid cap, and then if it does really well from there, it goes into large cap. Very few companies have made this right. I mean, completely. I mean, we did a study over the last 10 years. We found that hardly 8 companies in the small cap space actually transited, sorry, not 8, hardly 3 companies transited from small cap all the way to large cap.
Right.
In fact, most companies actually transited downwards. Like in the 100 companies that we looked in the large cap space, actually there are only 61 who are large cap, and actually 39 have gone into mid cap or have in fact vanished altogether. So that's the negative side of stock markets. It's not like you have to get invested in the right company. Very few companies make value for you. A lot more actually destroy value. So coming back to Flexi, most fund managers will have a more of a large cap plus bias because Flexi cap, as its name, is largely meant for investors who are recently coming into markets. So somebody asked me today, Raghav, I'm coming to mutual funds, equities for the first time. Where should I put? I will naturally tell him, boss, get into a large cap fund. Flexi cap is actually one level just above that, and multi cap is above Flexi in that sense. So obviously, in two things, I think if the big difference again between Flexi multi is also timeline. So if you want to say multi, I would say, you need to have at least a 3-year, 4-year plus kind of an investment horizon. This is not a trading oriented fund. Flexi cap, you can even come in if you have a very positive view on markets, and since it's largely large cap dominated, or you can even come in for slightly smaller periods. So I think both categories are important. Both categories are large. In fact, Flexi cap has between Flexi and large cap, they are the two largest categories in the equity space. My sense is that multi-cap being a new category will also emerge in the next 2-3 years as a very, very large category, more as a fill it, shut it, forget it investment. For lazy investors like me, I'll just put it in and forget about it. I will look at it after 5-10 years